Hello everyone and welcome to our next NAP. NAP stands for Nonprofit Auditor Points and I'm Irina Ryzhkova, your nonprofit auditor. I designed these NAPs to help nonprofit community to understand GAAP and accrual method of accounting better. Today we're going to summarize, today is the last episode in the series for nonprofit revenue recognition. And we're going to step back and connect everything that we discussed in the previous 10 or 11 NAPs regarding nonprofit revenue recognition. Why I decided to do the series about nonprofit revenue recognition? Because the topic is challenging. It's governed by two different standards, 606 and 958. 606, revenue recognition for exchange transactions. Sometimes we call them contracts, when recipient, donor who gives money to a nonprofit, receive in exchange services or goods of the similar value. That's really exchange transaction, very similar to for-profit revenue recognition, standard 606. The second standard is specifically for nonprofits for contributions, 958. And the revenue is recognized for contribution when it's unconditionally promised. Contribution we used for everything that falls under contributions, which are gifts, grants, bequests, donations, pledges, promises, various terms that we use, but they're all contributions. And we recognize revenue when it's unconditionally promised. We also discussed what is the condition, and we talked what condition needs to include barrier and right of return the funds. And if there is a barrier and right of return the funds, then we do not recognize until the condition is substantially met. Again, unconditional promise, that's when that's when the revenue is recorded and the standard. Then we discuss what means promise, that intent to give. It's not a promise and it needs to be commitment and preferably in writing. Then if we do recognize unconditional promise as revenue, then it also can come in two flavors. It can be without the donor restrictions and with donor restrictions. Restrictions can only come from donor and either can be time restricted or purpose restricted. And then if it's released, then only can be released when the restriction is satisfied. Then we talked about multi-year grants, and regardless of the fact that they are for multiple years, we still need to recognize and the standard for the full amount as soon as it's unconditional. So that's all that we did. And lastly, in the last episode, we did discuss in-kind contribution. And the difference for revenue recognition, there is really no difference, because in-kind just means contribution that done not in the form of cash, but in different forms. It could be free or below fair market value rent. It could be goods. It could be professional services, or services that either enhance or improve non-financial asset. So when we put it all together, we actually see the logical framework that we as accountants should apply to every agreement that nonprofit receive in order to determine how to record revenue properly. And you can see that the framework itself can be quite complicated. And however, if we do understand this framework, every revenue recognition becomes as easy and straightforward. So today I want to simplify and summarize all of it. So if you remember nothing else from this series, remember the sequence that I just went through. When revenue comes into your organization, you need to ask 4 questions in the following order. Question number 1, is it exchange transaction or contribution? This is your starting point, and it's always have to be first before you do anything else. And remember, this comes not from the name on the agreement, not because it looks like something. It only comes from the substance of the document. So therefore, question number 1, is it exchange or it's a contribution? In order to give an answer to that question, you need to read the agreement and based on its substance to decide, is it exchange transaction or it's a contribution. If the organization providing goods or service to the party that pays for these goods or service, it's exchange transaction, direct exchange. It's a standard 606. Examples: tuition fee paid by students, ticket sales paid by participants of the event, membership benefits where members receive some benefits in exchange, program fees where the program fees paid by the participants that receive service in exchange, and certain government contracts where the government is recipient of these services, direct government. If the transaction is non-reciprocal, meaning that the donor does not receive equal value in exchange, just maybe a recognition of the name or thank you letter, it's not of equal value, it's contribution. And we use standard 958. Most donation grants fundraising proceeds that fall in that category. Okay, so that's the first and foremost question we need to ask. Is it 606 or 958? Exchange transactions or contribution? Once you determine what is it, then the second question we're asking, if that's contribution, we need to determine if it's conditional or non-conditional. So if we see that there is a barriers and right of return the funds, then it's conditional. If there is if they're not both present, if there's no barriers and right of return the funds, they're unconditional. Conditional support, we do not recognize as revenue until condition is met. If it's unconditional promise, we do record as revenue right away. Question number 3. If it was unconditional, then is it restricted classification or unrestricted? Do we classify it as a donor contributions with donor restrictions or contribution without the donor restrictions? And if we classify this as with donor restrictions, then we need to remember that we're going to release it later. And the last question, were the release satisfied? If it was satisfied, it can be satisfied because the time restriction is lifted or purpose restrictions is lifted. Satisfaction of this restriction does not affect revenue recognition. So revenue is not recognized once it was recognized only first time. Okay. Just one more time to summarize. First step, exchange transaction or contribution. If it's exchange, we recognize revenue when obligation is met and we deliver services or goods. If it's contribution, we'll look further. We see if it's a conditional or non-conditional. Conditional, we don't do anything, we do not recognize. Unconditional, great, and it's a promise, we do recognize as revenue. But when we recognize revenue, we need to see if it's with donor restrictions or without the donor restrictions. If there is restriction, we're recording with donor restrictions, and then we need to see if any of these restrictions should be released at the end of the year, and then we record reclassification entry, decreasing net assets with donor restrictions and increasing net assets without a donor restriction. When you think about revenue this way, it becomes more structural, less than just it feels like it. So what I will really want to remind, regardless if that sounds confusing, you don't understand, make sure that every agreement that nonprofit receives, you spend some time, read it through, and understanding who are the party to the agreement, who provides what under the agreement, what obligations of each party under this agreement, and if there's any conditions and restrictions. So if you can identify those main areas of compliance on agreement, it will give you clues whether it's a contract or it's a grant, it's conditional, non-conditional, restricted, non-restricted. If it's multi-year grant or one-year grant, do you see the payment schedule versus right of the funds? Payment schedule does not affect revenue recognition, it will simply affect cash. And also, we need to remember that because the accounting standard is quite complex and we do record based on GAAP, it's not always clear to the board members what does it mean, specifically if it relates to multi-year grants when we recognize revenue upfront for the full amount, but the next years we do not recognize any revenue, but we do record a lot of expenses. It might present distorted picture of overall organization performance, and it's a job of accountants to explain to the board members why our financials indicate significant surplus in the first year and maybe deficit in the future years. It's nothing to do with overall nonprofit performance. It relates to revenue recognition. So it's a purely financial presentation, but it does not direct reflection of the organization operational activity. Actually, quite opposite. Sometimes a lot of program work needs to be done in year number 2 and 3 and 4 for multi-year grant. So they might be operational heavy and performance important, but revenue will be sitting in the year number 1. And again, it's important to the accountants to explain to the board members what restricted revenue means, that we do record as revenue, but we need to release it in accordance with the donor restrictions and wishes. And last thing that I want to remind, that revenue recognition for Form 990 is different under GAAP. There's two government bodies that actually doing the standards. Form 990 not necessarily follow GAAP, and the sum in-kind revenue is not recognized under the IRS rules, while GAAP do recognize in-kind professional services. Therefore, presentation might be different, and it's important to understand the differences, explain it to the board so the board can see the full picture why financial statements are different from the Form 990. Does not mean that the Form 990 is wrong or financial statements are correct. They just governed by two different standards, because GAAP focuses on the financial statement presentation for auditors and donors, while Form 990 main focus is the public reporting, tax compliance, and transparency. And they just two different sets of rules. A lot of time they're very similar, but there are some distinctions. Understanding the distinctions prevents unnecessary alarm. So, understanding how to read tax filing forms. If your organization receives significant grants and complex fundings, and the organization received multi-year grants, and it's highly recommended to spend time to understand your revenue structure, to educate your board and management, and to explain to them and get them on the board so they understand what is grant, what is exchange transactions. As we indicated before, there could be some judgment involved. In kind revenue, some assessment, management estimates might be involved. So the involvement of executive director, boards might be also necessary, just to make sure that everybody is on board and agreed with assessment and evaluation. And document that evaluation. I would say every time when there is a question and there's some judgment involved, documentation is a key. So the auditors and funders and potential donors and governance can see how final determination was done, what information was used, and how it was assessed. Again, revenue recognition for nonprofits is not simple. And if you feel sometimes overwhelmed, frustrated, completely understandable. But hopefully I gave you some framework that can help with some of that frustration and becomes more manageable. But if you have any questions on revenue recognition, please do not hesitate to email me, and I will be more than happy to give you some guidance. My email is io@irynacpa.com. One more time, io@irynacpa.com. Thank you. Hopefully you enjoyed the series, and looking forward to see you for the next NAP. Have a wonderful week.